Welcome to S&P Capital IQ's monthly loan market overview clip. I'm Steve Miller, a member of the Leverage Commentary and Data team. Over the next few minutes, we'll review recent market trends. In preview, flagging investor sentiment and weakening technical conditions cooled the loan market in May, sending loan prices down and clearing yields higher. Before getting into our market analysis, we are pleased to announce the launch of LeverageLoan.com, a free website promoting the asset class. On it, you'll find recent market stats, news and analysis, leverage finance job postings, and an online version of LCD's market standard primer explaining key terms and dynamics in the leverage finance process. A link to the website can be found in this clip's YouTube information box. In May, the loan market was in the grip of events. With the macro picture darkening, the S&P LSTA index suffered its worst monthly loss since November, retreating 68 basis points. High yield and equity sold off even more. The S&P 500 was down 6%, while the Bank of America Merrill Lynch High Yield Master Index dropped 1.2%. This grim backdrop took its toll on market tone. CLO issuance, though still robust by recent standards, fell to $2.9 billion in May from a 4.5-year high of $5.1 billion in April. Likewise, inflows into loan mutual funds fell to $133 million from $557 million, according to data provider EPFR. The new issue market cooled significantly in May in response. Arrangers were therefore forced to hike the yield of twice as many of new issue loans as they reduced. That was a complete turnabout from earlier in the year when the market was running hot. With investors calling the tune, new issue clearing yields widened by 30 basis points on average to 6.7%. By early June, single B loans were printing in a 7% context with double B loans at 5 to 5.5%. Looking ahead, the bumpy ride of the past month shows no sign of abating. For one thing, the pipeline of M&A-driven loans stood at a robust $16 billion on May 30th. For another, managers expect investors to stay guarded at least until the situation in Europe stabilizes. What's more, with the high-yield market also weak, takeout activity will likely remain slow. In May, the leveraged loan market suffered its biggest default since 2010 when Houghton Mifflin filed for bankruptcy. As a result, the loan default rate climbed to a 14-month high of 1.1%. The increase was widely anticipated on the buy side. Indeed, LCD's latest manager survey from mid-March found an average default rate forecast of 1.6% for 2012 and 2.7% for 2013. To wrap up, some final points. Many participants worry that 2012 will see an unwelcome rerun of the summer sell-off that plagued the market in both 2010 and 2011. Europe, after all, is struggling yet again to ameliorate its debt and fiscal issues. The more forbidding primary landscape, arrangers say, will keep opportunistic deal flow such as repricings, dividend recaps, and amend to extends to a minimum. Arrangers, therefore, say unless tone improves, summer activity will be sparse. That brings us to the end of our overview. For more information on the loan market, you can check in with us on the web or via LinkedIn, Twitter, or Facebook. The links for each is in the description of this video below. You can also download this presentation at slideshare.net.